Welcome to The Explainer. We're going to break down real estate investment math and the traps that catch everyone.
Think investing is simple? Let's walk through the life of a deal to see where the real math is.
First things first, how do you measure your actual return? It all comes down to one thing: financing.
This is a big one. Don't mix up the property's return, the cap rate, with your return on the cash you put in.
So how do you calculate it? Easy. Subtract your debt from your income, then divide by your down payment.
And there you have it. Your actual return on the cash you put down is 8%.
All right, now let's talk about ownership. Over time, your property's value grows. We call that appreciation.
And here's another classic trap. Appreciation is just the value increase. Equity, that's what you actually own.
Okay, let's get into the trickiest term of all, depreciation. It has two totally opposite meanings.
So you've got to ask, are we talking about the property's actual value, or are we talking about taxes?
For appraisers, depreciation is a bad thing, a loss in value. But for the IRS, it's a huge tax benefit.
Now, to calculate this tax break, you got to know the rules. And rule number one, land is never depreciated.
Let's see how it works. You subtract the land value, then divide by 39 years for a commercial property.
Now for the big day, selling the property. Let's pull this all together and calculate your profit.
It looks like a lot, but it's just two steps. Find your adjusted cost, then find your net sales price.
The difference between them? That's your total taxable gain. In this case, a whopping $270,000.
But hold on, here comes the biggest trap of all. That profit isn't all taxed the same way.
Yeah, the IRS actually splits your gain into two buckets, and they're taxed at very different rates. See, you've got the gain from appreciation and then the gain from all that depreciation you deducted. This shows the split perfectly. The IRS recaptures those deductions by taxing that part at a higher rate.
So, is there a way around this tax bill? You bet. Investors use something called a 1031 exchange.
But here's the catch. It only defers the tax. It doesn't erase it. So the final question is, when do you pay?